Oh,
Hi, everyone. Welcome to the McAllen Message. My name is Susan Damiani, Director of Gift Planning and for the McAllen Society. I hope everyone had a wonderful Easter holiday, but we have a great power hour that's coming up on April 18th at 1 p.m. And our presenter is with me right now. John Ceparano is partner and founder. Am I right? You're the founder?
one of the founders.
One of the founders of Madeira Wealth Management. And you might be familiar with John. He's a very good friend to Gift Planning. He has done a couple of things with us. You know, he's been on the panel for Meet the Experts, and he was just recently on one of our power hours in February with Smart Charitable Giving. And now with the, tax time, we are all, very busy working with our accountants. I hope so. I hope everybody's filing their taxes. And I know our deadline date is April 18th. Is that correct, John?
That's correct.
Okay. So with this presentation that you're going to be doing and with, tax time here at hand, what are some of the things that we should be looking at and why we should be signing up for this power hour call on the 18th?
Well, if you filed already, either you got good news or you got bad news about your taxes. But why should you tune in? Well, if you're a new retiree or a seasoned retiree, it's interesting. Tax laws change and you provide opportunities. There was a new act that came into play back right at the end of December called the Secure Act. And there's a lot of hustle and bustle going on in the media about all this. But we've gone through the act and see how it applies to our type of clients. And our type of clients are the ones that have saved their whole life, accumulated some wealth, and they're trying to protect it basically. And one of the ways to protect it is to minimize your taxes so the IRS doesn't become one of your charities. So you asked me, like, what's important about the Secure Act? So we're going to go into, when we talk on the 18th, about things that are in effect for 2023 and going forward. So one of the basic things there is that they increase the age of when required minimum distributions start. It used to be 72, now it's 73. And you say, so what? What's the great opportunity about that? Well, we can relook at your charitable intent, to your kids, which are non-deductible, or to your charities, which are kind of like working with Susan, when you're helping out the school. The other ways are to reduce taxes through your qualified charitable distributions, which are still available, not at 73, but it's still at 70 and a half. A lot of people think that came together. And QCDs are basically qualified charitable distributions out of your IRAs. And the beauty about that is, if you were going to give money away to charities, you want to be able to do it and reduce your taxes at the same time. If you just do your standard deduction, you may not be able to take that. So what we'll talk about is how you can bunch these deductions and get these charitable distributions out on your timeline, not the IRS's. So tune in for that. And then there's also donor advised funds. That may make sense. Similarly, if you want to gift a significant amount away, or at least want to get a deduction in 1 year, out of 3 years, out of 5 years, if you're stuck with standard deductions. And the main reason people are getting stuck with just standard deductions is because they've limited what you can deduct. And we'll go over that. And why and when to consider Roth conversions. Well, why should anybody want to pay taxes before they have to? Well, there's a number of good reasons. Depending on your circumstances, and we will go over that. 2026 is going to be a key year if nothing changes. Well, some things will, but in 2026, all of the tax bracket tax rates are scheduled to go up by 3% and possibly more. So legislatively right now, everybody will be paying at a higher tax rate. So if we can do things now at a cheaper rate, it may make sense, and it depends on your circumstances. Just remember, your heirs will love getting a Roth IRA. They will hate getting a regular standard IRA, because Roth IRAs mean that they're not going to pay any taxes and will not have to under current tax law for the next 10 years. If they get a IRA, they're going to have to pay tax by the end of the 10th year, unless they paid along the way. So it's talking about saving the family money, not just yourselves. So there's a lot of planning, a lot of opportunities. Secure Act created some things that you have to work around, and some things you can work right through if you know what you're doing. So to me, investments and taxes should be synonymous. They have to work together. And if you don't, the only person who winds up paying more taxes is you. And the only reason that happens is because you're not informed. So we can get over that hump, and we look forward to talking on April 18th. With a lot of these opportunities are out there and how they may apply to you. Look forward to it, Susan.
That's great. Thanks, John. I really appreciate you taking the time and sharing your expertise. John is an alumnus of the business school. And also just keep in mind that this power hour is 1 hour from 1 to 2, and it's free advice that you're getting from a professional financial advisor. So not only will we be covering all of these topics, but if you have any financial questions, by all means, you can ask John, and he will do his best to answer that for you as well. So please join us. We'd love to have you. That's April 18th from 1 to 2, the Power Hour on Smart Charitable Giving. Thank you, everyone. Thanks, John.
Thanks a lot.